In a world where wealth and income inequality continue to make headlines and spark debates, one term often stands at the epicenter of these discussions: the 1%. This select group of individuals represents the upper echelons of society, possessing wealth and resources that appear almost unimaginable to the average person. Their influence extends far beyond their economic affluence, shaping economies, politics, and even societal norms. But how precisely do the ultra-wealthy accumulate such vast fortunes? What are the sources of income that propel them to these heights? First, who makes up the 1%, and how do they amass their wealth? Before dismissing the idea of joining this elite group, let's debunk a common myth. It's not just a bunch of heirs. A significant 45% of the 1% have climbed the ladder of affluence through their own business ventures. But that's not all. Investments play a substantial role, contributing 30% to their success. While it's true that 15% inherit their wealth, the path to prosperity appears to be paved with entrepreneurship and shrewd financial choices. In the realm of affluence, financial success is not a product of chance, but rather the result of discipline and a meticulously crafted strategy. Revealing the inner mechanisms of how the 1% handles their investments is like unlocking the secrets to financial success. As the findings of a thorough 2021 survey of the American financial landscape are examined, a conspicuous pattern comes into focus, one that carries vital insights for those with aspirations of wealth accumulation. Consider this: for the wealthiest 1%, nearly half of their financial assets are dedicated to corporate equities and mutual funds, while equities form only a modest portion of the portfolios for the bottom 50% of wealth earners. Moreover, as individuals ascend the wealth ladder, the percentage of their holdings in equities tends to rise significantly. A similar trend unfolds in the realm of real estate. The lower 50% of wealth holders have over half of their assets tied up in real estate, in stark contrast to the top 1%, who allocate only around 12% of their wealth to real estate investments. But here's the real puzzler. Why didn't the ballooning real estate investments by the bottom 50% during the mid-2000s housing boom lead to a significant narrowing of the wealth gap? The answer lies in a deeper analysis that goes beyond mere asset holdings. It involves considering both assets and liabilities. When we take this comprehensive view, we unearth a troubling trend. Alongside the surge in real estate assets, there was a substantial spike in household debt. This debt effectively offset the gains derived from real estate investments, preventing the wealth gap from closing. But what truly sets the stage for intrigue is the allocation of assets among different wealth groups, revealing an intricate dance between risk and reward in the pursuit of financial success. Surprisingly, those situated in the top 10 to 50% display a more conservative approach. They hold a smaller proportion of high-risk assets such as private businesses, equities, and real estate compared to both the top 1% and the bottom 50%. While these high-risk assets have the potential for substantial rewards, they also carry inherent risks. Instead, the top 10 to 50% tend to invest in assets that exhibit more moderate growth when overall valuations rise. Astonishingly, as their total wealth expands, their portion of wealth actually diminishes. It seems that it is this intricate interplay between assets and liabilities, risk and reward, that ultimately paves the path to financial prosperity. The cornerstone of wealth building lies in generating a consistent and substantial income, encompassing not just one's salary, but also business earnings, rental income, dividends, interest, and various other cash streams. So which investment opportunity is the best for generating a consistent income stream? Business or real estate? Both avenues offer unique advantages and considerations, and the choice ultimately depends on financial goals, risk tolerance, and personal circumstances. As we weigh the scales of investment options, it's essential to explore the unique narratives that accompany each path. Investing in a business and acquiring real estate share some similarities when it comes to their financial structures. Both typically involve a blend of equity and financing. But what about the complexity? Is acquiring a business as challenging as purchasing property? It might be surprising to many that the processes are more alike than they appear. When it comes to property purchases, one typically follows a series of steps: searching for the perfect property, negotiating the price, arranging financing if needed, performing inspections, and ultimately completing the transaction. This is a process that countless individuals have effectively managed. Likewise, acquiring a business involves its unique set of steps: identifying potential targets, conducting thorough due diligence, negotiating terms, securing financial resources, and ultimately sealing the deal. In essence, while acquiring property is a complex undertaking, the process shares fundamental similarities with acquiring a business. The key distinction, however, lies in the intricate financial aspects at play. Consider factors like ROI and the inherent risks associated with either a business or property purchase. Let's break down what ROI, or return on investment, means. It's a measure that gauges how profitable an investment is. The formula is simple: ROI equals net profit divided by an initial investment multiplied by 100. Now, taking a look at the S&P 500 data, the average return on investment in the US property market clocks in at 8.6%. If we focus on residential properties, they tend to bring in a higher average return of 10.6%. On the other hand, commercial properties show a slightly lower return, standing at 9.5%. M&A deals often outshine real estate transactions by delivering higher returns on investment in a shorter time frame. A skillfully executed acquisition can ignite synergies, expand market share, and supercharge profitability and overall value. Venture capitalists relentlessly pursue average annual ROIs of 50% or more for their high-stakes bets on early-stage companies, while private equity groups anticipate average annual ROIs of around 35% for their investments in more mature and stable enterprises. These divergent ROI targets in real estate and the investment sector mirror the contrasting risk profiles and potential returns inherent to each investment type. From a financial perspective, a high-performing business can unleash substantial cash flow. This cash flow can be reinvested to propel further growth or be distributed as dividends, offering investors a steady income stream. In the realm of real estate, rental income can generate cash flow, but its predictability and magnitude may not be as robust. Perhaps this is why, according to Forbes, 66% of billionaires' net worth comes from their ownership of private businesses. In today's economic landscape, there's a growing trend towards entrepreneurship and a new American dream of being a business owner. Successful entrepreneurs are seizing opportunities in mergers and acquisitions, recognizing the potential advantages of acquiring existing businesses. The allure of entrepreneurship, combined with the potential for higher returns and strategic growth opportunities, is reshaping the landscape of financial success and long-term wealth accumulation. The Credit Suisse Research Institute estimated that at the end of 2021, there were 62.5 million millionaires worldwide, up 5.2 million from a year earlier. This is the largest increase in millionaire numbers recorded for any country in any year this century. So what is stopping the average person from joining their ranks? When contemplating investment choices, deciding between buying a business and buying a property ultimately depends on your financial goals, risk tolerance, and aspirations. Both avenues offer unique advantages and challenges, but the trend towards business ownership suggests that the path to financial success is evolving. Whether investing in real estate or diving into the world of M&A, the key is to make informed decisions and seize the opportunities that align with one's vision for the future. Wealth is not a matter of chance, but a product of strategy and education. The formula for success is no longer a secret held by the elite. It is readily available and waiting for those brave enough to take that first step towards their financial legacy.